पूरा क्लियर आ रहा है ना? Good morning. So last time we were talking about what is options and how options are one of the alternative for hedging a position in the market, especially in the adverse financial movement. So options, as the name suggests, you have a choice that whether to exercise or not to exercise. In length we had discussed about this. Let's recap that two parties are there in options trading. One is called buyer, another is called seller. Buyer is having long position, seller is always called short position holder. Seller is also called as writer. Buyer has got right and seller has got obligation. There are two products, one is called right to buy, another is called right to sell. Right to buy product is called call option and right to sell is called put option. So buyer can buy right to buy or right to sell, so it could be long call or long put. Similarly, seller can sell put option, that is seller can sell the call option or put option. Seller can sell right to buy or right to sell, because right to buy or right to sell is a kind of product, options product. So there are four different strategies appears, simple strategy, that it could be long call, that is buy or call option. It could be long put, buy or put option. It could be sell put option, that is your short put, and it could be sell call option, it could be short call option, short call. So these are the strategies. Now what happens, depending upon market condition, one can have a various combination of these options, and these combinations ultimately gives various strategies. Like it could be during bullish period or bearish period. When market is bullish, a different strategy could be there. When market is bearish, different strategy could be there. So, and if there is a difference of the two product price leads to, that is called a spread, one can take care through a spread. So bull spread, bear spread, calendar spread, strangles, straddles, butterfly, condor, and like that various strategies could be developed, right? That's the way it works. Now next to this is payoff. Payoff also we discussed. Now when pricing we were talking about, two prices were involved. One price was price of options itself. Option is a product, so it must have a price when it is exchanged, when it is traded. So two products are there. One is called options, another is called underlying. So option is traded, the price of options will be there. And when underlying is exchanged, the underlying price will be there. So price of option is called as option premium or option price, whereas underlying price is called a strike price or exercise price. A strike or exercise price could be there. Now, when we consider this, you will find out here that suppose someone has taken a long call position. When a party will take a long call position, when it is expected that the price of underlying will move up, and the party has to have the purchase of that need of that underlying. Any underlying you can consider. Underlying means it may be currency, it may be commodity, it may be a stock, it may be index, it could be whatever it is there. If you want to buy and that is expected, price could be expected to move up, then in that case it is better you can take a long call. So what this long call will be? You are taking a call option, means always payoff is looked from the buyer's angle, from buyer's point of view. So a buyer will be taking the call position or buying the right to buy at a given price. At a given price means price of that underlying. Whatever the price of underlying will be there, buyer will be buying that price. For example, we were talking about USD. Let's say existing price of USD right now, a spot price of USD is suppose 83 rupees 16 paisa. So 83 rupees 16 paisa is the price, but you need USD. Maybe being an importer, you have to make a payment or you require USD, but at a later stage, not now. What you can do, you can simply buy when you need it, but you have a set of information out of which you had an expectation that USD may go on premium and 83.16 may move to, say, in 3 months of time or 2 months of time, it may move to 84. Now concern is you are looking for a buy position. Second concern is it is also not very sure it will go on upside only. There could be possibility dollar can go, USD can go on discount, and instead of 83 rupees 16 paisa, it may come to 82 rupees 86 paisa kind of situation. So you want to protect yourself against this volatility, and you want to make sure that let's the price should be fixed today, price should be fixed now for a future date. So if anything moves up, anything goes up, price goes up, you should be able to buy your USD or any underlying at that specified price. And if price moves in your favor, like if price comes down, then you should be able to take benefit of that coming down. This is what it is there. Had it not, futures were also one option, one alternative. So futures also has to be met. Now how it is going to work? How it is going to apply? Say at 83 rupees 56 paisa, dollar is available 2 months hence, and that is what 2 months hence in options market at 83 rupees 56 paisa is available. That is called a strike price. That is strike price is there. And once you book this, now if dollar moves beyond that, you are free to take it at, you are free to exercise your position, your options, and you will receive dollar at 83.56. That is what your price of underlying. That is your strike price at which you have entered into options contract. At a given price of options, that is when you are buying options, that price also has to be paid. That is called premium. Say at 20 paisa premium. So 20 paisa premium means that after paying 20 paisa, you blocked your position, you entered into contract where you will be allowed to buy at 83.56 per dollar if dollar is moving up, dollar is becoming costlier. And if dollar is remaining in market because of any reason below 83.56, you can buy it from market and let the options to expire. Don't exercise your options. This is a basic condition. So you know today itself that your upper limit of the option of the dollar price is going to be 83.56. And if you talk about effective cash flow, net cash flow, then you can add your 20 paisa premium, and that premium will be, that 20 paisa premium when we talk about, that premium will be actually outflow. So you can add and you can make that effective outflow is 83.76. 83.56 is the strike, 83.76 is your cash flow. So the moment in market price moves beyond 83.76, you are in a net benefit. So payoff is going to be calculated on the basis of a strike versus a spot, that is 83.56, and cash flow is going to get calculated on the basis of 83.76. So this, if you consider, you will find out here the options payoff which is available. This options payoff is nothing but whatever price. If suppose this is 83.56 or 83.56, so what happens at 83.56, this is K is a strike price. The moment price moves up, you will be exercising your option and you will be gaining out of it, because 20 paisa per dollar which you have paid upfront as an option premium is actually your sunk cost. You have already paid. So whether you exercise or not exercise, that amount has already gone. So that should not be part of your decision making. So decision making will be based on the payoff. But when you make a cash flow calculation, then this will be, you will be adding your 20 paisa of the premium also. So look into that. Your K is coming here, but slowly you will be adding your premium, and it is not at 83.56 where you have already taken the decision to exercise. Rather, your cash flow, your net effective profit will be coming after 83.76. That's the way you have to evaluate. This is the difference. So this payoffs, actually it is counted on the basis of whatever the gain is there, profit is there. That's the way it is. So increasing the price is going to be set. Now from here, one very important question arises: who will decide what is going to be premium and how much it to be the premium? Option premium or option price, how you will decide? How much is the amount? We know two parties are there. First party is option seller, another party is option buyer. Now will the buyer be deciding the price or seller will be deciding the price? Normally we understand that price is decided by the seller, because in this case also you will find out seller is taking the huge risk. Why seller is taking unlimited risk? Because price can go to any level. Suppose we have in our example right now set where 83.16 was the spot price for the USD as on date. 2 months option was at 83.56 with the option premium of 20 paisa, making it that option means USD will not go beyond 83.56. Now in this situation, why option buyer will buy after paying 20 paisa at 83.56 where the effective cash outflow is going to be 83.76. Why it is so? Because this is basically the difference in expectation between the option buyer and option seller. It is because of nature, behavior of the two parties. Say options buyer is thinking that USD may cross 84 in 2 months of time. So if USD can cross 84, it can be 84 and 0.16. So there will be a possibility of 1 rupee extra movement from 83.16 to 84.16. So, conservatively, buyer evaluates if a product is available at 83.56 with a premium of 20 paisa, so effective payment I have to make is 83.76, right? So, my net final outflow is going to be 83.76. Now, certainly price will go beyond that, so I will be in benefit. I will be in benefit. And if because of any reason price doesn't go up, my cost will be only 20 paisa, I will be actually taking from the market. So, my upper, in whatsoever is my upper cap is fixed, is 83.76 of the outflow. Why seller is actually giving this kind of offer? Seller might have got expectation, say that whatsoever reason USD will not be beyond say 83.70. It will not go beyond that. I am actually talking as a simple common man language instead of how any trader thinks of. So, 83.76 could be upper limit. Whatsoever reason price will not move up. And if price will not move up, then I will not be in a loss. See, what is the entire game plan? How it works? The gain to the seller is, option writer is only premium. Gain to the option writer is only premium. And gain will be there only when option is not going to get exercised. Gain will be there when option will not be exercised. When option will not be exercised, what will be the condition when option is not going to get exercised? When price in the market will be lower. Yes or not? Price in the market will be lower. So, when price in the market will be lower, the party will not come to you to exercise, because party will take it from market, and you will have the premium lying with you, that is your net gain. You do not require to have it. The moment options is going to get exercised, it means market price must be higher. And then in that case you have to buy it. Say market price is, instead of 83.56, it is 83.60. So, 83.60 is there. So, how you will evaluate it now? 83.60 is the market price and 83.56 is your strike price. So, a spot is higher than a strike. It is in the money. And if it is in the money, option buyer will exercise. So, when option buyer comes to you, says, give me your USD. At what price? 83.56. What you will have to do as a seller? As a seller, you have to buy it from the market. At what price? At prevailing price of 83.60. So, you will be buying at 83.60 and you will be selling at 83.56. 4 paisa loss. But still you are in comfortable position, because you are having 4 paisa outflow, 20 paisa already inflow. So, you have a 16 paisa gain. So, your gain will be till the time market has got 83.76. Suppose really market price has gone to 83.76. So, at 83.76 you will be buying, and at 83.56 you will be paying 20 paisa loss, and there in another side 20 paisa gain you have already earned in the form of premium. So, you will have a net effect 0. But if price goes to 83.77 in the market, then 1 paisa loss. And as price moves up, your loss will keep on increasing. Right? Are you getting me? Price moves up, you will keep on, loss will keep on increasing. So, a question arises that how to decide what ought to be the premium. One thing is fixed now, that premium has to be determined by the seller, that is option writer. That is what fixed now. So, a question second arises, how to decide how much is going to be premium. What will be the right approach to decide about the premium? Right approach to decide about the premium is that what is your expectation related to movement of your underlying price. Especially we are talking right now call option. We are talking about call options. How much price could be there? So you start thinking what could be the extreme price movement. How much you think of? Suppose you thought of extreme price movement could be say 83.76. This is my expectation. So you can synthesize variety of products for that 2 months of options. 83.76 will be there. So I can synthesize the product. A strike price 83.56. And that 0.76 is the extreme condition I am considering. So 83.56, 20 paisa will be the premium. So 83.56 is a strike. Here premium, strike plus premium is extreme expected price movement in the future for underlying. So that what should be the normal as a business person, as a seller has to have? Nothing should go from pocket. That should be the first case. Nothing should go from pocket. You should not end up in loss. That should be the strategy. Suppose you decided another strike price, say 83.50. You can have a premium of 26 paisa. You can decide 83.20, can have a premium of say 50 paisa, 55 paisa, 60 paisa, something like that. You can decide about that, and combinations should be such that these combinations ultimately should not make any outflow from your pocket. It should not be that. That should be your approach. Now, the moment we consider this, a question arises. Is it scientific or it is going to be something of that nature where without any kind of calculation we will able to make it? So, answer is it is very scientific in nature. Question is, if you are the seller, how you will decide? First decision has been there that how much price will be moving up. What could be the price fluctuation, underlying price will be there because it is derivative. You will be deriving the product price based on that, how much it is coming up. It is the premium which is traded. Actually, in the options trading market, you will find out it is premium which is traded. So, how you decide about premium will be going up or down. If suppose today I decided that price is expected to move up to 83.76 and I am making a strike of 83.56. So, my premium is going to be 20 paisa extreme, that is making, because theory says or thumb rule says that sellers should set the strike price as high as possible. How seller will earn? Seller will earn in the condition when options will not get exercised. Seller has to earn. Who is setting the price? Who is setting the strike or premium? Seller. So, seller, and what is the way seller will be earning? Seller will be earning only when there is no exercise. But what is the rule? Set the strike price as high as possible. And now when you are setting the strike as high as possible, so set why 83.56? Set 84. Chances of getting exercise will be very little. Now there is a catch in the market. What is the catch in the market is, if you will make a strike price too high, then buyer will not be available to you. Your product should be sold also. And so you have to play with that behavioral expectations that people should feel it is a beneficial product. Then only they will buy. So theory says your best part will be there, you set your price high, but don't set that high that no buyer is available to you. When no buyer will be there, even option will not come to, premium will not come to you. So you have to make that attractive so that people will come, people will buy with this expectation that they will be able to exercise the option, you will be getting. So premium should not be again very big. Is it clear or not? because premium has to be paid upfront. And these are the certain, now understand the mental dilemma, how this dilemma is going to influence the process. So there has been always a challenge how to decide about it. Okay, what could be that? So first thing which is really required in this, that you set a particular strike price, or even prior to that, set your expectation in a given period, how much value will move up, underlying price movement, how much volatility is there in your underlying. That volatility will decide how it is going to work. Okay? So let's work upon the pricing technique. And pricing technique, when we say, it is premium determination. How option premium is going to be decided. It's a numerical based exercise. I request you all to be ready with me as for calculation of numerical and sure short question of examination. It is coming in the examination. There is no second thought of that. Right? So let's start with it. How it is working. So I am going to talk about, let's say, just a minute. Look here. Let's consider that a stock, I am changing the example deliberately, making it comfortable to you, that it is not only USD, it is not only rice or gram or wheat, any product you can take, and price movement is that. Even we can take example of XYZ and ultimately it will give you the feel how the price could be determined. Suppose one stock is there or one product is there whose spot is right now S0 is 100. Clear? Let's say in 1 year of time, deliberately I am taking 1 year, just timing to make your calculation comfortable. I can take even 1 month, I can take even 15 days, I can take 2 months, any of the period I can take. In trading environment, options is available maximum for 3 months. Why I am going to use this? Because entire calculation will have some more set of information, and that is, one is called time, T, another is called discounting rate, say R. Discounting rate also has to be used. And it is essentially advised, or you can say compulsorily instructed, that whenever you are using T, T must be in year. And so R will be per annum. Rate always has to be put per annum and T has to be in year. So even if you talk about 1 month, it is something 1 by 12 has to be the value of T. If it is 1 day, it is 1 by 365 you have to use. 1 by 365. So time has to be written specifically in terms of years. Generally we take example of quarter. Quarter means 0.25 year. 3 months, 0.25 year. That's the way we value. Okay. So you understand here that T always, and I am taking 1 year, so at least, and it is running in power. That's why I am taking 1. Right. For ease to calculate. Otherwise, you take your figure, multiply it, certain value will be there. Another one important part, instead of using PVIF or PVIFA as a tool for discounting, we will be using e to the power minus RT for discounting and e to the power RT for compounding, which is nothing but the formula for continuous compounding and discounting respectively. This is continuous compounding, this is continuous discounting. So now the formula indicates E stands here exponential. So it is R is the rate and T is the time frame, which is in the year and per annum rate, and your calculator gives you that value, e to the power RT. So for me, if suppose, and R is normally, in a normal condition, we consider risk-free rate. Assume 7% is the risk-free rate. So R we will take 7%, which is nothing but 0.07, and T as we mentioned 1 year. So e to the power RT will be e to the power 0.07 into 1, that is e to the power 0.07, which exactly you will get the value whatever it is written in that. You can calculate with 1.072, right? Now, not for examination, not for academic environment, but practically, if suppose I am there in that environment where I don't have a scientific calculator, where I can easily calculate e to the power RT, I can simply calculate through normal PVIF also, it will be there. So what will be value? Here e to the power 0.07 into 1 is making 1.072. This is what you mentioned. Whereas if I don't have this, I can use 1.07 to the power 1 is equal to 1.07. I can easily make it. Right? That's the way we can. If you ignore this figure, it will become approximate figure. That's the way it is. You want to make another change, you can look into 0.07 is per annum to the power 1 upon, no, let it to be that continuous way. Let it to be this figure, but for academic purpose, you have to calculate this way. Now, how the price will be set? How price could be there? Thumb rule is where what we discussed till time is sailors should not be ending up paying from pocket. Sailor has to make assure that. So whatsoever price is there, a strike price and premium, the combination of the two, summation of the two should never ever be higher, higher than a spot price. Okay? Or lower than a spot price. It is that if suppose that two combination is lower than a spot price, combination of the two will be lower than a spot price, seller will get some benefit, whatever difference will be coming up. Okay? So normally, what is the gain in the call part? What is the gain to the seller is that seller's premium called C should be greater than how much? Whatever the spot is there, or whatever K is there, minus a spot is there. Okay? So, reverse, you use reverse. S minus K, 83.60 minus 83.56. It is 0.04. Here C is 20.20. 0.20 is greater than this. It is working. How long it will work? Till S minus K is equal to C. Why I was writing? Right now I am giving you this for pricing point of view, and when pricing point of view is there, it means I am thinking from seller's point of view. I am thinking from seller's point of view. And from buyer, means long position holder point of view will be there. Long position holder will be gaining when K is smaller than S. S is less than K. K is less than S. So K means a strike price. When a strike price is less than a spot price, gain will be there. Right? So let's go to scientific approach from seller's point of view to decide what should be the right premium. First important method which we are going to use is called binomial method. So in binomial method, when we consider binomial, what is binomial? It is dichotomy. Two branches are there. Always two opportunities are there. Two possibilities are there, and that we decide about it. Okay? So we are starting binomial method for option premium calculation. Right? So come back to this. Suppose 100 is the spot price which is expected to move 10% up or 10% down in 1 year of time, which will make it 110 or 90. We are trying to get now call premium. How much call premium is going to be there? So 110 or 90, either of the two price could be possible in future 1 year hence, whose spot price is right now 100. Only two options we are going to, two branch we are going to take, because method is binomial. In real life, any number of values could be taking place, but here we are considering only two of the value. So how it is going to get considered? What are the calculations? How much? Suppose K is 105. Means a price, K is a strike price, is 105. So now question is ready. What is the question? What will be the language of question? A stock is right now trading in that rupees 100, which is expected to move either 10% up or down. If a option seller is setting a strike price of 105, what should be the call premium? Simple question. 5 marks. Should I repeat the question? Question is, a stock, you can name the stock, I can pick any of the stock, any of the price, but ease to calculate, I am taking 100. So a stock is right now, a spot price is rupees 100, which is expected to move 10% up or down in 1 year of time. If an option seller set a strike price of rupees 105, 105K I have written, what should be the call premium? Without mentioning, you will come to know this is a binomial method. You have to apply. And when you have to apply binomial method, apply it now, get the value. Now first we will talk about, in this question solution, what is going to be the probability that it will be moving up to this side or that side? What is going to be the probability? So, probability calculation first we are going to apply, followed by premium calculation. So, probability calculation, the formula will be P is equal to, P stands for probability, e to the power RT minus C D upon U minus D. This is the formula for probability. E to the power RT, D is decrease, U is decrease means downward movement, U is upward movement. Upward movement is 10%, that is 0.1. 1 plus 0.1 is 1.1. So, value of U is 1.1. Downward movement is also 10%, 0.1. 1 minus 0.1 is 0.9. So, value for D is going to be 0.9. Value for U is going to be 1.1, and e to the power RT will be the e to the power RT. If we have taken assumption that R is 7%, T is 1 year, e to the power RT value is 1.072. So, we will use this formula and write 1.072 minus 0.9 upon 0.2. This is U minus T. 1.1 minus 0.9, 0.2. What is the value? How much P is coming up? Give me the answer. 0.86. So, P is now 0.86. P is considered normally as the probability to move up. So, 1 minus P will be probability to move down because it is binomial. So, 1 minus this will be 0.14. It means that the possibility price will go up from 100 to 110, that is 10% up, have got 86% probability, and price will come down from 100 to 90 will have only 14% probability. Is it clear? So, we got probability. Now, we will apply this probability for the calculation of call or put premium. So, what the call or put premium will be? Formula for call premium is going to be C is equal to probability of upward movement value Fu plus 1 minus P of Fd into e to the power minus RT. We will discount that value. That is the way value has to be counted. Means P is the probability, Fu is the intrinsic value when there is upward movement, Fd is the intrinsic value when there is a downward movement. And intrinsic value means is the value of option. So, how to calculate, how to decide about what is going to be Fu? And Fu is, right now I was mentioning you that value or gain to the long position holder to the option buyer is going to be, in the case of call, it is S minus K. S minus K, right? So, Fu will be, when upward movement is there, $110 minus 105, how much is going to be their value? 5. 90 minus 105, what is going to be the value? How much value will be there? Minus 15. Okay? What will be the value? 0. Recall previous class. जब एक्सरसाइज ही नहीं करेगा, 90 पे बाजार में बिक रहा है तो 105 पे क्या करने जाएगा वो? कहा था पिछले क्लास में कि ये कभी भी नेगेटिव नहीं होता. Okay, so it is going to be 0. Put the value and give me the answer of call premium. How much premium ought to be? So P is how much? Anyway, you have mentioned probability. Point कितना probability बताया था? 86. 0.86. Is it really in 2 digit only it has come? Or it should be 4 digit? 0.86 directly. Okay, fine. So 0.86 multiplied by 5. 0.8, 4.3 plus 0.14 multiplied by 0, 0. So it is 4.3. Discount it because multiplied by e to the power minus rt. So e to the power minus rt is how much? How much is that? 1 point? Oh no, that was e to the power rt. I am now talking e to the power minus rt. Yes, or otherwise directly also you can put, when you are putting that power 0.07, at that time you put power minus 0.07. It will be ultimately 0.9328. Okay, 0.9328 multiplied by over 4.53, whatever coming. $4.011. 4.011 is going to be your call premium. This is the value. 4.011. Okay, subject to correct calculation. If your calculation is correct, it is coming. How much you can charge? 4.011, which you can consider 4 rupees should be your call premium. Anyone has got any doubt here? I'll move further ahead. Yes. D is actually downward movement. How much is downward movement? 10%. 10%, that is 0.1. So 1 minus 0.1 is equal to D. 1 plus 0.1 is equal to U. So 1.1 is U and 0.9 is D. Any other query? So the same formula is used for put premium calculation also. Same formula is used for put premium, and my request is that take 2 minutes of time and calculate put premium also. So here formula is C or formula is P. Formula will remain same for calculation. 2 minutes, 120 seconds, give me answer. Combination of 2-3 calculation can make one full question. Give me the answer of put premium. How much put premium will be there? All condition remains same. A spot price is 100, a strike price is 105, risk-free rate is 7%, and 10% upward movement possibility, 10% downward movement possibility. 1 year is the period. No? You can ask any query if you have. Okay. How was your answer? No answer. Okay. Anyway, I am solving it. Now we are talking about put premium calculation. Here all conditions are same. So the probability calculation will remain same, because P is equal to e to the power RT minus D upon U minus D. And look into no term has changed here. So whatever probability will be there, that will remain same, that's 0.86 and 0.14. So in formula now P and 1 minus P is not changing. Then what we have to look into FU and FD. So FU will be there. Now we are considering put premium. Put premium, the intrinsic value will be there for buyer is K minus S. K minus S. K minus S when we will make, that is 105 minus 110, what will be the value? 0. And here 105 minus 90 will become 15. Put the value 15 here. This value 0, so you can time being ignore for the calculation, but you must mention in your equation value 0. 15 into 0.14, that is I think 2.1. 15 into 0.14 is 2.1, and then 2.1 you can discount, and discounting value you have already calculated 0.98. So multiplied by that 1.96245. So 1.96245. So you can consider put premium 1.96. So in the same condition, call premium is going to be 4, put premium is going to be 1.96. This is the calculation which simply indicates that market is expected to be highly bullish. Chances of getting down will be lesser. So that's why in the put case premium has to be as low as possible. Is it clear? Now this is a single period calculation. If suppose there is a double period calculation, but before going to double period, again I am giving you opportunity to ask the question. Any question you have? Any question you have? No? So let's talk about double period calculation, and if it continues, how it works. This phase from here to here is considered to be single phase, one period. Now we take that, this further moves up, say 10% up, making it 121, 10% down, so making it 99, 10% up, 10% down, it is 81. So 4 values comes on the right side. 2 from this side, 2 from this side. I am writing only 3 value because the middle value is common in both the cases. So value has come. So my question extends that suppose a call writer writes an option for 2 period, each of 1 year, at a strike price of 105, whose spot price is 100, and having the possibility of 10% up or down movement in both the consecutive years. What will be the option premium for this call option? Now, here just to make complication, we can have a different kind of a growth in second year, not necessarily 10% up or down. First year we can take 10%, second year we can take 8% or 15%, any of the figure. So there is no compulsion to have same figure in both the cases. I am using same figure for make use of available calculation. Right? So look into that, how 2 period methods can get applied. Double period calculations, how it is going to get applied. In this case, since 10% up and 10% down is there, so again probability is not changing, and I am taking advantage of available value 0.86 and 0.14. So that calculation is already available to us. Now next to this, we will start from right to left. Right to left means we have to calculate FU and FD. FU is the value when upward movement is there. FD is the value when downward movement is there. Okay. So upward movement FU value, how much is value here? What is going to be the expected spot after 2 years period? How much is the value? 121. So, and which options we are talking about? Call option. So in the call option, 121 minus how much? 105. How much is the value? 16. So your FU is 16. Clear? What will be the FD value? 99 minus 105? 0. Apply formula. Give me answer. Your FU value is 16. FD value is 0. So 0.86 multiplied by 16. Discount it using that your discounting rate of 0.98, whatever you have calculated, and immediately give me the value. And my request to everyone will be there to calculate. This is a call premium. That's why we are talking about a spot minus a strike. Quick. 12.8284. So your value is coming 12.8284. Clear? Now next calculation. Everyone is getting same value? How much? 8587. 8358. Why so much difference in the given figure calculation? You calculate 0.86 multiplied by how much is the value? 16 multiplied by how much is the value? 0.9. 9345. Twelve point. Anyway, that you take care of, whatever you 12.824, 8284. Okay, do your calculation. Be very careful. Lot of difference should not be there because it is going to be used as a coefficient and later on it will change the impact and price difference will lead to a lot. And in MCQ, it may create confusion. Okay, so be very careful. And why scientific calculator is allowed? It is not for a fancy purpose. It is meant for it. And I have advised in the beginning itself, when you are using in finance, don't round off in between. Only final answer should be rounded off. So must have a practice of using scientific calculator. If you start every time just simply taking initial after decimal 2-digit and then your answer at the end will vary like anything, it will create problem. And evaluator will not hesitate in deducting your marks. Because very clearly, boldly on question paper it is written use of scientific calculator is allowed. It is not only a fancy, it is purpose. Okay. 0.9323, 0.9323, तो 0.9323 कीजिए इसको. You have to calculate that way. They are factor. And never ever use your factor wrong, because factor will have a magnification effect. 12.8284. Yes. One calculation is over. Now go to second calculation. Here again look from this branch. So two prices there, 99 and 81. 99 and 81. So how much is the FU? 0. Very good. How much is FD? 0. So what will be the value here? 0. Very easy to calculate. Okay. Now this is again you repeat it. Here at this point you will consider this 12.8284 as FU and this 0 as FD. And recalculate it, bring these two figures here now, back. Now you need not to use your 105 for re-evaluating your FU and FD. Your FU has already been there one phase back. So FU is 12.8284, FD is 0, apply it. So 12.8284 multiplied by 0.86 multiplied by 0.93, giving you the value. Quick. 10.2855. So we can say 10.29 somewhere around. Final answer is going to be your call premium. Okay, 10.29 is the call premium. अब ये क्वेश्चन 5 मार्क्स से ऊपर का उठ रहा है, और अगर पुट प्रीमियम निकालना हो तो 10 मार्क्स बना देंगे. कॉल और पुट दोनों डाल के 10 मार्क्स का एक क्वेश्चन कंप्लीट, फाइंड आउट दैट वैल्यू. ओके, so let's calculate the put premium here quickly. Calculate the put premium. Now again to help you, e to the power RT will not change. U and D is not going to change. So P will not change. When P will not change, 1 minus P will not change. So what is now we have to calculate is FU and FD. Extreme right. Now I am not going to rewrite, I will be simply rev and write. But you prepare a phrase flow. Write down 100, extend 110, 90, 121, 99, 99, 81. Phrase calculation. Calculate put premium. Quickly. FD is 6 here. Okay, FD 6 and here FU 0. So what will be your back value? Calculation dear, faster. Start calculation. Zero point 0.7831. 6. So here your value is going to be 0.71. .7831. Now calculate for these two, 99 and 81. What is the strike price? So what will be FU? FU will be 6 and FD will be 24. So first time you are finding that you are getting a value for both FU and FD. So your calculation is becoming now effective. How much? This is what put premium. Final answer. Okay, very good. This is what the reflection, the moment you get a feel of calculation, you will find out calculation becomes very fast. 7.94. So where the call premium was, how much call premium was? 10.2855. So here it is, call was 10.2855. Put premium is how much? $10 question. Understand, question will be very simple. A stock having 100 as the spot price, expected to move 10% up and 10% down in 2 consecutive years. Each year 10% up and down. If a strike is set at 105, calculate call and put premium. Given that risk-free rate is 7% and time period is 1 year each. Time period anyway, it has already been written on the upside also that 1, 2 years subsequent 1 and 1 year. It is called 2-period calculation. Period could be 3 months, could be 6 months, could be 1 year. Normally these 3 periods possible in the examination. If it is 3 months, what will be your T? 0.25. 6 months, 0.5. And accordingly, and now you know why you should calculate everything e to the power RT, e to the power minus RT separately, so that you can reuse and understand. These questions normally considered to be premium in calculation. Reason is very simple, and otherwise also in derivatives. 90% marks in final examination, like out of 70, 60 approximately will be numerical question. Only numerical, numerical, numerical. Only one question can come theory. Because in this case also in financial derivative, setting a theory question is also, actually your answer should be numerical. Like explain the market situation where you can apply your straddle strategies and book your profit. Assume through your illustration. Now question is theory, answer is numerical. Write 2 pages, 10 marks. If I will be evaluator, give you 2-3 marks. Write 1 page, start a straddle definition and reason, illustration with example, take 10 out of 10. Derivatives doesn't ask any story. It is a numerical paper, ask numerical answer. Even for theory questions, I am repeating again. Question may be theory, answer has to be numerical. Right? Let's now move to, again, I can have analytical question also here, which has to be proved through numerical. Prove that in a same situation, same economic condition, a spot price possible movement, and at the same strike price, call and put premium behave differently. Yes or not? Call and put premium behave differently. What I have asked? Have I asked theory question? No numerical value is in my language, but you can't prove that call and put premium behaving differently in the same market situation. Everything is same, 2 different value is coming up. You can write only once you have already done this exercise. Otherwise question समझ में नहीं आएगा कि कहना क्या चाह रहा है, और उसके बाद कहानी लिखेगा. और ऐसे क्वेश्चन को इवैल्यूएट करने में मुझे 15 to 30 सेकेंड्स लगेंगे. कहीं न्यूमेरिकल नहीं है, थोड़ा स्टोरी कॉल एंड पुट प्रीमियम का डिफिनीशन लिख दिया है, 1 नंबर डाल दो, 10 में 1 डाल दो, हो गई बात, कहानी खत्म. क्लियर कट. इस सब्जेक्ट के लिए बहुत केयरफुली आप न्यूमेरिकली प्रिपेयर कीजिए अपने आप को. लेट्स मूव टू द नेक्स्ट क्वेश्चन. I hope no question you have from your side. And reminding you, I know you people are adult, matured, but always keep in mind, I am having little concern for those people sitting here, putting their time but not writing, not using their pen and paper. I also know, I also have a good brain, but I understand the brain capacity. कितना आप यहाँ से बाहर निकलते निकलते सब साफ हो जाएगा, तो मत आओ. बट इफ यू आर कमिंग, मस्ट सॉल्व इट. फाइनेंस नॉवेल नहीं है. You require calculation, and if you are hesitant to calculate or ignorant to calculate, you are committing a big blunder. बिकॉज जो आपको देख के लग रहा है कि आपको समझ में आ गया, 95% चांसेस आपको समझ में नहीं आया जब तक आप कैलकुलेट नहीं करोगे. एंड टाइम इज ऑल्सो वेरी इंपॉर्टेंट. वाई आई एम कॉलिंग इट्स अ प्रीमियम्स क्वेश्चन ऑल्सो? Because if once you know 10 marks question, it will not take more than 5 minutes. Whereas on an average for 10 marks, 20 minutes is available to you. तो ये आपको सोचने की ज़रूरत है. Let's look the another one. Here, whatever we had assumed in this question, binomial, one very important aspect was, and that important aspect is premium is set from the seller's point of view. It is the sellers who want to have that information, and for say call premium, if we talk about, whatever difference between S minus K is there, that should be covered through premium. Difference between S and K should be covered through premium. Recall? If 100 is the spot price, 105 is the strike price. But interestingly, this should be ST, not S0. 100 is S0. SO. Present. The then expected spot. So your spot minus a strike is not present spot. The day when option is going to get exercised. At that point of time, what a spot is coming. So at that time, I don't know what is going to be a spot. So if suppose I am expecting it could be 110, my expectation or my fear is that the price will move to 110. Then 110 minus 105, I should have at least 5 rupees premium. Am I clear? Why so? As a writer, if price goes to 110 in the market and I have already given a right to some buyer that you can buy it from me at 105, certainly he will come and exercise the option. He will ask me, well, you have already booked me, give me at 105. Okay? Upward movement. Now up, down, I am just taking one movement. Binomial closed, my chapter is over. I am moving to next chapter. Understand one very important point is that you are exercising the option premium or things for that share at that point of time when buy or sell is there. What my assumption is? Assumption is, suppose S0 is November 5th. ST is January 5th. Is it clear? You have promised as a writer to someone that, okay, on January 5th you can come and buy share from me. Right? My basic assumption is that you don't have a share. When somebody will come to you to buy, you will take it from the market and you will give it to that. Right? On January 5th, if buyer comes to you for exercising the option, you will pick it from the market and you will hand over to them. Where is that dividend comes into picture? Today I buy a share and hand over to you. Where is the dividend coming in picture? I am not holding anything. If you are holding, you say that I have already got a share where I am promising it. You are going for a short call because you have underlying asset with you. Anyway, I am lying with you. I am not asking you before January 5th. And on January 5th also, it is not guaranteed that I will be asking you. Depending upon the market price, I will decide whether I will come to you to exercise or not. Am I clear? So dividend doesn't come into picture. Right? Now, on January 5th, the 2 months hence, when you decide price is expected to move to 110, then in that case the difference will be counted. It should be considered. And we have already seen in the binomial that probability has to be specified, and accordingly we decide, because not necessarily it is a very uniform and moving up and down. Depending upon the probability how it is going to get decided. You change your U and D, you will find out different percentage will come up. You change your R and T, different percentage will appear. Because e to the power RT is also your first term. And always keep in mind that whatever there is in the formula, that becomes function for that particular factor. So if you are calculating probability, probability is a function of E, R, T, U and D. Because it is depending. Some may have a direct relation, some may have inverse relationship. And that decides about value. That's the way calculation is going to work. But ultimately, this is through illustration we can think of. We don't know ST. So what is ST here? If we have to determine ST minus K, S0 is known with certainty as on date. K is known with certainty as on date because that is what it has been offered, that is what it has been, priced. So a question arises that how ST will be decided, because whatever your expertise is there, but it is very difficult to say that what is going to be ST as on date on S0. What will be the price on January 5th is really tough to say on November 5th. Right? So then in that case, again we start applying it. Secondly, it's not like that it will be only 110, there could be possibility 111, 109, 108, any figure could be there. So ultimately, can it be possible? Ultimately, you have to take as a premium difference of the two. And problem is, this term is known, but this term is not known. This term is function of present spot. So actually, can it be possible we can replace this ST through SO by using some technique? If we can replace, we can make it. What is conceptual component here? Conceptually, ST is nothing but changed value of SO in a time. Other things remaining same. And whatever time change is there, can we call it, it is a volatility? That's a volatility is there. Okay? So we can talk about volatility which could be measured through sigma. Right? Okay? Or time being, we can consider not necessarily in the form of sigma, we will consider that there is a possibility of deviation D in this market. How much price is going to deviate in this market? And deviation itself is function of number of factors. Everyone's behavior ultimately decides the market. Everyone's behavior. And when everyone's behavior decides the market, then question appears how to measure that behavior. Second, if behavior is function of the market condition which itself is dynamic, then behavior will also be dynamic. Or not? Every time it will be changing. It will be something like you asked me at 11 o'clock in the morning, what is your opinion towards the market? I mentioned opinion about the market. You asked me at 3 o'clock what is your opinion, and my opinion has changed by that time towards the market. Why it has changed? Because from 11 to 3 o'clock I have got more information. Whatever information I had got, that value has changed. Very much possible. And that's what the movement in the market. More and more movement is there in the factors, more and movement is there in the market also. And when too much of the movement is there in the market, because of that unstable conditions, we say market is highly volatile. Right or not? Market volatility is normally there. Why from morning high and low and everything is happening in the market? Why momentum is there? Because of conflict of opinion depending upon the buyer and seller. How the buyer and seller is going to decide about that, what kind of condition is there. I am expecting price will go up, you are expecting price will come down, you will be very interested to sell, I will be interested to buy, buyer and seller come together to make the market possible. If there is certain clarity related to market movement, it could be a spike or trough. That keep on working. How you are thinking. Not only the direction of movement, degree of movement is also there. You are thinking 10% movement will be there, I am thinking 20% movement will be there. For 10% movement, you might have been now in a selling position. I will be saying that a still buying position is available. So you sell, I am buying. These are the certain things which you have to understand. You have to apply. Very fantastic. And market is highly scientific. Highly scientific. Those who don't understand scientific system, they say it is gambling. Market is highly scientific in nature. Stochastic in nature. behavioral in nature, and behavioral bias is there. And it has always a pattern which is normally considered in the mathematics also, that no human being can generate the random number for long. Yes or not? Do you agree? Those who studied mathematics must be knowing random number can't be generated by brain. Why? Because brain starts thinking in a pattern. And when brain starts thinking in a pattern, market has to have a pattern. And if anything is in pattern, this is called science. It is highly scientific. This is understanding is really required. And that's why you'll find out, even those who are deeply involved into market, in the terms of number of actions called day trader, they believe on technical analysis. And what is technical analysis? It is a scientific pattern. Nothing more than that. They don't want to hear any story. They simply want line and chart, which is a pattern. Every time you look into that, that is a pattern. And pattern decides where it is going to move up. So its pattern is going to be there, but it is dynamic in nature. So can it be possible that this D, which will be every moment will be changing, so can we make that first you calculate D and then you calculate normalized D and D. So first we will calculate D and then calculation of normalized D and D. Now here it comes. You are talking about a spot market, and a spot market is going to change. A spot market is something like where dynamic. What about this options market? Is it not dynamic? Is it not changing? I say no, that is also changing. That is also very dynamic in nature. And if that is dynamic in nature, then in that case can we consider now for you, understand, very important point is that for you a strike is fixed. Doesn't mean that options market is fixed. Options market is also changing. It's dynamic. That has got deviation. So can we consider deviation in this market also D? So now we have to calculate not the only deviation in the spot market, even in the options market. Both the markets we have to calculate the deviation. And when both the markets we have to calculate deviation, then a question arises here. 8. Are these two deviations on same? What do you feel? Deviation in the spot versus deviation in the options market will remain same? No, because number of factors may be different. The factors influencing, some factors may be common, but some factors may be different also. And when the factors are different, or degree of impact of the same factor will be different, then in that case these two D will be different. So when these two D will be different, can it be possible we can mark it D1 and D2? So now we are using D1 is for spot deviations and D2 is for options deviations. And both we will normalize. So we will be normalizing ND1 and we will be normalizing ND2. Okay? Both we are going to normalize. Now the moment we talk about these normalizations, what will happen? Our calculation will become simple. That instead of having through illustration, we can use it. I'll show you so that you people can have a look of it, and you can jot down the formula, what I am writing. Your calculation of D1 will be D1 is equal to ln S upon X or K. Let me show you the formula. Just a minute, just a minute. It's coming. I'll explain every term here to save the time by seeing the formula. It is ln means natural log. We will take natural log of s upon x plus r plus sigma square by 2, that is half sigma square into t upon sigma root t. That is what d1 is going to be there. Write down the formula. This formula you have to remember. Question is obvious, it's coming. Write down the formula for both call and put premium. Call premium is s minus k. Here x has been written for instead of k. X is also indicating as a strike price. And d1 is ln s upon x plus r. R stands risk free rate plus half of the variance, that is sigma square, into t, the time, divided by volatility into root t, sigma root t. Okay? And where you have written r plus half sigma square, that is sigma square by 2. If you make r minus sigma square by 2, it will become d2. Or you can calculate d1 and minus sigma root t will give you d2. Normally people prefer to calculate d1 and instead of recalculating d2 they directly deduct sigma root t, it will be d2. So finally st is nothing but s0, how the value is coming up I am writing there. So you will find out your value. Is it visible here? I am there in the screen. St is equal to S0 into and D1. What is this and D1? Whatever deviation is coming, that will be there. Now that you look into that S and D1. Okay? So if we can calculate deviation and normalize it, normalized deviation could be considered as one of the best deviation. Normalized deviation means S naught is there, that will keep on changing, will lead to ST. Till ST naught it is there, ST is a value. ST will be value. Okay? S0 is a value, is a price, a spot price and 0 period, that is today, and a spot price in T period. T period. If today is 100 rupees, what will be after 1 month? ST. So depending upon what is 1 month volatility, that is D. No, and volatility will keep on changing frequently. So it will be normalized value will be coming up. Average नहीं है, normalization and average में difference है here. Now these are mathematical terms, so you know these two are not same. Averaging could be there, that I can take it every day, changes, and then whatever volatility is there divided by number of observations, I can make it a simple average. I can take a weighted average, but no, it is a normalization one. I saw the formula for that normalization also. Is it okay? And for your kind information, you will be supplied with the table from D1 to ND1 conversion. Table will be available to you. Right? And the book which you have got supplied, especially the John C. Hull, which I have shared with you, look at the last of the book, table is available. Okay. So value is known to you now, S0 and D1. Clear? That is what it is there. Now x, that is also changing. X is K here. We have started using the word K. K into ND1, ND2. K into ND2. So practically, you find out here it is actually S minus X only. But since S is ST and ST is not known to us, so we are bringing it back to S0, and S0 is actually ST, and S0 is S0 into ND1 is equal to ST. And that's why the value has been taken. Now X into ND2. Clear? Now where S is standing? S is standing in the 0 period. Am I right or not? S0 means 0. Now S which has come is today, S0. And when your X is available, the day when you are going to have exercise or expiry date, yes or not? Expiry date, it will be there. So it is in a future date. Bring it back, e to the power minus RT. Discount it to present. So instead of S minus X, it will be X into e to the power minus RT. And with changes in the market volatility and D2. Clear? What is the deviation? Is a function of government's approach, government functions, or it is a function of the market volatility sigma. Sigma we are using common in both because underlying is same. If we talk about a stock, it is meant for a stock. If we talk about currency, particular currency, it is meant for currency. It is same. So sigma is going to be same. Time frame is same. A spot movement in 3 months of time and options movement in 3 months of time. Time frame is same. So then in that case, D1 calculation will be there. Understand objective type question, D1 function of it. Interesting applied question, D1 is function both direct and indirect to sigma. Sigma numerator में भी है, sigma denominator में भी है. Impact क्या होगा? T numerator में भी है, T denominator में भी है. So if suppose market volatility increases, premium increase करेगा, decrease करेगा, increase करेगा. क्यों? Because numerator has got a power 2. Denominator has got sigma, numerator has got sigma square. Denominator has got root t and numerator has got root t square, that is t. So the positive movement is higher powered than the downward inverse movement. These are the certain MCQs will get created. Start looking into inside of the formula. It will give you message how the market will behave. Then start asking question to yourself, why these behaviors are, why market is behaving like this. As time will increase, suddenly volatility will increase. As rate will increase, more return will be expected. Why rate, why R will increase? Because inflation is increasing. Inflation term is not there, but I can ask you direct questions that whether the premium will increase, call or put premium will increase with increase in inflation or decrease with inflation. Direct book में तुरंत नहीं लिखा हुआ मिलता है. Look into that formula says like that. Is that clear? That's the way value you have to create. Now, once you calculate D1 and D2, you have got quick calculation. What is going to be the value? S you know it is 100, X you know it is 105, R you know it is 0.07, T you know it is 1. So अब मुझे आप D1 बताइए, D2 बताइए, उसके बाद मैं ND1 और ND2 बताऊंगा आपको. Quickly D1. Time given to you for D1 calculation is 60 seconds. Quick. वैल्यू डालिए, कैलकुलेटर यूज कीजिए. S अपॉन एक्स, S इज 100 अपॉन 105. याद रखिएगा कितना हो रहा है, उसका नेचुरल लॉग निकालिएगा. लॉग टू द बेस 10 मत लेना, ब्लंडर हो जाएगा. लॉग टू द बेस E और नेचुरल लॉग ln आपके साइंटिफिक फंक्शन में होगा, ln दिया हुआ. साइंटिफिक कैलकुलेटर निकालिए. नहीं है. Oh, I have not illustrated here. So, Ellen, always keep in mind that whenever you can have a self correction also, if value is less than 1, it will always be minus. And now you calculate it is 0.07 plus sigma is not known to you. I am giving you sigma, say 10%. So 0.1 square, 0.01 sigma square, right? 10% is the sigma I am using. T is 1 year. Use the value. R 0.07. Sigma is 0.1. So sigma square will become 0.01. नहीं होगा क्या? होगा ना 0.01. तो जल्दी करो ना कैलकुलेशन. Calculate for yourself. How much? 2.115. What? D1? Huh? No, can't be. 0.27. Look into that carefully. Now here this calculation will go wrong, entire thing will go wrong, because everything is ultimately depending on D1. Then change to ND1. Blunder should not be there in calculation, and don't expect that I will do your calculation for you. How much is the value? Numerator 0.27. Okay. So here value is coming, D1 is coming 0.27. Right? What will be D2 value? Minus 0.1. Okay. So how much will become? 0.17. D1 will be 0.17. Now from D1 we were going to have calculation of ND1, and from D2 we will calculate ND2. So look into how this calculation takes place. Quickly, there is a table which will be supplied to you in the exam as well. Understand here that we will have a two table. One table is meant for negative value, another for positive value. One is for negative value, another for positive value. Negative value table, this table which is there is meant for negative value. It is written as less than 0. Okay. If we should have got D1 is negative or D2 is negative, any of the negative, we should have used this table. But our D1 and D2 both are positive. So I will shift to positive table. This is positive table. Here one more thing you will find out. Look into here, negative is already written. It is not only on the top, this side also written. So how the value will be coming up? 0.27. How to look into it? 0.27, first digit look into row, second digit look into column. So look into 0.2 in the row and 0.07 in the column. So 0.2 is in the row, 0.07 is in this column. So 0.2, this one. So your ND1 value is 0.6064. ND1 value is 0.6064. Which ND1? D1 was 0.27. If your value should have been 0.274, then how you should have calculated? Let's learn that portion also. We'll understand rest of the things afterward. 0.274. We can't calculate 0.274 here. So what we will do, we will use a smart approach called interpolation, no rounding off. We will first calculate for 0.27, then we will calculate for 0.28. Whatever the difference will be there, we will distribute into 10 parts, and one part multiplied by 4 parts, add it to 0.27, you will get 0.274. That is called interpolation. Is it clear or not? If the value should have been 0.2745, then we should have used the difference 0.27 and 0.28, divided it into 100 parts, and then 45 parts, add it. Had it been negative table is always in decreasing order, so minus it. Value will be there. And not only that, look into the upside, they have given you the technique also how to interpolate. It is already on upside in the table given. This is what I am mentioning you. Right? So, your 0.6064, and in 0.1 it is 0.5675. So, your ND1 and ND2 both is available to you. Write down fast. Go back to call premium formula. S is 100. Write down quickly. S is 100. ND1 is how much? 0.6064 minus X is 105 into e to the power minus RT. How much value you had got e to the minus RT? 0.93 or something like that. Huh? 26 multiplied by that your ND2 just now you have got. How much was ND2? So multiply the total value. Four point two. 4.2055. Okay. How much? 5.08. S कितना है? How much is S? 100. ND1 कितना है? ठीक है. X कितना है? 5. e to the power minus RT कितना है? वेरी गुड. और उसके बाद ND2 कितना है? वेरी गुड. सो हाउ मच इज द वैल्यू कमिंग? 5.0865. राइट. सो this calculation is over. You have put formula also. Excuse me, please. Only few more minutes. My calculation is over. You can stop calculating. Rest is your own wish. When you are going to have practice, not necessarily only call, you can use put premium also to calculate. The method which we have used is called Black-Scholes method, which is normally perceived to be little tough method for calculation. I deliberately didn't mention the name in the beginning. So first you learn, and once you will learn with concept why this formula is there, what are the role of every element in this formula, your understanding and remembering the formula will become easy. So what I did, I started from S minus X. Then I thought S is ST. ST is not known to me. So X I left it, then I substituted ST with S0, that is SS, and S and ST has got relationship. Substitution, it will become ND1. Why ND1 I explained you. And X also, the options market is also highly volatile, keeps on changing, so that ND2. And options market, X is meant for future date, S is meant for today. So bring it to today by making e to the power minus RT. That is what is there. And when deviation we talk about is subject to function of so many, like government behavior, which is reflected through R. R in turn itself is reflected through so many macroeconomic factors like inflation. Then it is related to volatility in that market, sigma, that is underlying market, bigger one. It is depending upon what kind of your time frame is there, T. It is also depending on your S and X, the spot and exercise price, relative measure of that, relationship of that, because they are in numerator denominator conditions. And it may be very different value can appear. So there also you are using logarithm, and that also natural logarithm. And if you have a mathematics background, you can understand what are the power of these instruments, how they are making the data refined and ultimately coming with the value. Last but not least, I had deliberately kept the assumed figure same in both the example when I was using method of binomial and using the method of Black-Scholes. Mr. Black and Mr. Scholes example, two together had given that, and even there I had made 10% movement up, 10% down. Here also I used sigma 10%, and ultimately you found that their value in call option premium for single period had come 4.011, which you had said 4.011. Here it is coming 5.0, and it is not only that, number of times in the real market happenings, I have always found that whatever the price is available in the market, generally available price versus binomial price versus Black-Scholes price, I have found Black-Scholes prices on the upper side, available price is in the mid, binomial is that on a lower side. Normally, this is the way it has been, which you can cross check using any of that given figure from the market, dip into it, you will get good thrill. This formula was given in 1973, long back. A little story of the Mr. Black. This formula worth Nobel Prize. Didn't get it because of death of Mr. Black in very faster pace, in very young age. Mr. Black wanted to take admission in finance, but didn't get opportunity. He was not selected into that team, and forcefully he had to take under compulsion. So he took admission in operation research, OR. Same university. His colleagues were there in field of finance, but he didn't lose his temptation towards finance, kept on working. Then after that, he, whenever he had opportunity, used to go and sit in the class of finance also. After that, he, after PG, this is, I am talking post-graduation. After PG, he wanted to take PhD in finance. Guide refused, you don't have a background of finance, you can't do PhD in finance. So he has to, under compulsion, he has to take PhD also in operation research, in mathematical modeling, and continued, but kept on attaching with that. And finally, his that mathematical knowledge, operation research knowledge, and here understanding of finance, and with the Mr. Scholes, two together propounded this Black-Scholes model. Actually, his entire group was, and the finance, other students were also at that point of time. The class he was attending of a Nobel laureate. Of course, at that time he was not awarded Nobel Prize. The professor who was teaching on the work of professor in 1955, professor got award in 1980s, but his all students, few students were there, group of students, all were finance wizard, and ultimately even allied students also had got this kind of a strength to give you the financial models. His famous student, another that professor's student, also got Nobel Award. He was a professor whose 6 students had got Nobel Award. He himself was a Nobel awardee. And I am talking about Markowitz, was a professor in portfolio theory. You must have studied. Efficient portfolio theory had been given by Markowitz. But उनसे ज़्यादा उनका एक स्टूडेंट नाम कमाया, वो भी नोबेल अवार्ड मिला, और नोबेल अवार्ड नहीं मिला उस स्टूडेंट के थ्योरी पे, उस स्टूडेंट के फाइंडिंग्स पे, उस स्टूडेंट के मॉडल पे लाखों पीएचडी हो चुके हैं आज तक टेस्टिंग में, और उस स्टूडेंट का नाम था विलियम शार्प, जिसका सबसे फेमस मॉडल है कैपिटल एसेट प्राइसिंग मॉडल, CAPM। आपने पढ़ा होगा प्राइसिंग ऑफ द वैल्यूएशन में K इज इक्वल टू RF प्लस बीटा इंटू RM माइनस RF, विलियम शार्प का दिया है, जो लिंडर का, जो प्रोफेसर मार्कोविस के स्टूडेंट थे, और ब्लैक वगैरह सब, ये सब एक ग्रुप थे, साथ थे। सो यू think of how people get motivated, people work on that, and even different disciplines come together and create. And interestingly, ये background model है. I had opportunity to work with some banker, some treasury operations, और वो अपना R लिख देते हैं ऊपर अपने मॉडल पे। और जब मैंने देखा, एक जर्मन कंपनी के, जर्मन बैंकर के साथ मैं काम कर रहा था, मैंने देखा कि ये तो बैकग्राउंड में तो भैया आपने तो ब्लैक सोल यूज़ किया है, और उसके बाद आर के कैलकुलेशन का स्टाइल, या आर आप रिप्लेस कर दो, टी रिप्लेस कर दो, सिग्मा कैलकुलेशन को थोड़ा रिप्लेस कर दो, और आप कहो मेरा मॉडल है ये। और उसके बाद अपने आप उसमें आर वगैरह लगा के, राइट्स लगा के कहो कि दिस इज़ मॉडल ऑफ ING, दिस इज़ मॉडल ऑफ HSBC, दिस इज़ मॉडल ऑफ RBS। तो बट बैकग्राउंड में किसका मॉडल है? इधर ब्लैक सोल का मॉडल है। इसमें थोड़े रिफाइनमेंट मार्टन ने किया फिर बाद में। तो दिस इज व्हाट ऑप्शन प्राइसिंग मॉडल, बोथ द मॉडल्स आर वेरी इंपॉर्टेंट, वेरी वैलिड, एंड इवन आफ्टर 50 years ऑफ टाइम यू विल फाइंड आउट दिस मॉडल। हाफ सेंचुरी से ऊपर क्रॉस हो चुका है, आज भी ये मॉडल वर्क कर रहा है, ये मॉडल पे लोग काम कर रहे हैं। सो थैंक यू फॉर द क्लास, थैंक्स।